morning and happy Tuesday. Welcome back to another morning live with Real Estate Mindset. Now, as you guys know, this video is going to be absolutely bonkers. Hopefully I'm annoying you as much as 10 years ago or more. When I made you know this, every decision Palantir made, FDAs, going public, building products, enterprise, large data sets, going to government, acknowledging American superiority, being pro-meritocracy, launching an AI platform, calling into question that AI models would actually be able to perform without orchestration. Every single one, our ontology, every single one of those was viewed as stupid. Someone's had a little bit too much microchips, if you know what I mean. One more quick video from Ted. Listen to what this guy has to say. Tell me whether or not you agree.
Do I need a license to sell you a beer? No. Do I need a marriage license? No. Do I need a trapping license? Do I need a hunting? Do I need a fishing license in the pond on my property? Come on. Licenses, permits, fees, taxes, stick them up. Well, you have to have management. That's not management. That's abuse of power. So they're going to take away my right on my property on Spirit Wild Ranch in Texas to manage my deer and balance my herd to harvest the surplus. And if you don't allow me to do that, hey, David Yakovich, are you going to come in and shoot my deer? Let me tell you something. You're not going to come in and shoot my deer, period. But you're not coming on my property and shooting the deer you don't allow me to shoot. Just write that down, guys. Write it down.
That was a rough start. And I forgot to say a couple of things. First and foremost, I love you. And thank you for joining me. And also, good morning to everyone. I appreciate you all being here. Scrog, are you going to the protest? We got our first protest on Thursday. I'm going out to support the community. There's going to be a protest in Conroe. We're going to march to the steps of the Capitol building and basically protest and rally against a 4,300% fee that the city is doing to small businesses, essentially for closing down the street to do events. So I'm excited about that. Scrog, I want to see you there. Please come with me. That's Thursday, 8 a.m. We're going to march there. I'm going to film everything. I'm going to release it on Real Estate Mindset. Really excited to join my first rally. And again, the reason why I'm joining that rally is to support the community, but I want to show you guys what we're supposed to do right now instead of, the whole civil unrest thing. We still have enough opportunity or some opportunity to rally and let people, the government, know that we're concerned about certain things and we're not going to put up with certain things. So we got to rally. We're going to do that. Good morning to everyone. Scrog, what's going on, brother? Vovo, I see you. Hey, Vovo, I see you. Keep commenting. I love you, man. I love seeing your comments. You make my day, Vovo. Merc, nice to see you. Ray, what's up, Ray? Oh, there's my buddy P Nice. I love your profile picture, P Nice. There's my buddy Scrog again. You going to go? Protest details? Yeah, I'm going to post it on my channel. We're going to go. All right, I want to see you there. It's in Conroe, 8 a.m. on Thursday. We're going to walk down the street right to the step. And I'm going to speak as well. I'm going to speak in front of the city board. And I'm going to ask them, like, hey, guys, please help us. Work with us. Show the constituents that we can work together with you to create a solution for the community. So I'm going to go up there and I'm going to ask them to do that because, again, they're elected officials and they can't be increasing fees by 4,300%. It's absolutely crushing small businesses. So where is Mitch? Mitch is working. Anytime you guys are wondering where Mitch is at, he's working. All right. He's working like crazy. He's either working on his book or he's working on the lawsuit or the bill or something to abolish property taxes. I'll let him know you say hi. Mitch, I don't know if he's watching, but if you are, Mitch, see, you're missed. I told you. Kevin, nice to see you as well. Good morning to the great Bender. It's so nice to see you guys. So what I'm going to do is I am going to, Governor Wiltshire didn't help us at all. Why you got to be so mean? Why you got to talk about his physical attributes? He's a fraud. We know he's a fraud. Stop being so mean and petty. All right. We're strong people. We're loving people. We're united. We could talk, we could debate, and we don't have to get personal. And yes, I am talking to myself because I know I get personal all the time, but I'm trying to do better, guys. All right. I have another mindset I'm coming into the new 2026 with, and that's being gentle and explaining things really well. I don't want to get frustrated with people. I've been fighting for a long time and I'm burnt out. I'm going to take a different approach, which is overwhelming love. We love and appreciate you. And Mitch, I love and appreciate you more. P Nice. Good morning. What's up from Texas? Let's get started. All right, we're gonna get started on the mortgage update. Sorry for rambling. I just miss you guys. I took the day off yesterday, and I hung out with my wife all day. We paid bills. It was amazing. I needed to go around people, and I was around people, and I was around my wife paying bills. It was absolutely exciting. And we went to the dollar store and got Christmas presents. I had the time of my life because I am beat up and I'm exhausted and I love you. So just know that. So I was off yesterday. Forgive me. Here is our first update, mortgage update. Now, the title of this is appropriately titled Mortgage Rates Are Frozen. It just changed right now, but this was essentially sideways. So the 10-year tracks mortgage rates. However, as you guys are about to see, recently there's been a bit of a divergence. And that's what's been really, see, it's now positive. That's what's been really surprising about post federal funds rate cut is the yields have been sliding. So it used to be to where this 10-year treasury had to be under 4% for residential mortgage rates, for FHA to be under 6. But right now, rates are under 6 for FHA, and this is well above 4%. And look, it's still sideways. Absolutely shocking. It's frozen. So I'm going to say, in my opinion anyways, there's manipulation going on here from our government. They're buying their own debt and they're manipulating this because they've lost control, because they've issued too much treasuries and too much debt to not only domestically to lenders that can use it as tier 1 capital to lever up 33-1, but they've also done that across the world. So they have very little control. So someone's manipulating this, in my opinion, completely flat. Let me show you what that's done to residential mortgage rates. The same. I mean, when we did our last live, I think it was on Friday, I think what were rates? 5.93, and the 10-year's higher now. So the 10-year goes up, and essentially mortgage rates stayed the same. It's very interesting, guys. So I think that they're trying, and I'm sorry, I have a cold as well and some sinuses. So I think what they're trying to do is stimulate the housing market by driving down mortgage rates. The first thing I thought was, I wonder if the Federal Reserve is purchasing mortgage-backed securities again, which would artificially lower interest rates as well without the 10-year necessarily having to go down. Because if the Fed buys those mortgage-backed securities, they don't have to hold the paper. So they don't have to be stuck with a certain yield. So I don't know if that's it, guys. But I did search, and according to Fed economic data, mortgage-backed security holdings are going down. So I don't know exactly what's happening, but someone's manipulating this. 5.92% for a 30-year fix. Now, remember, if you're shopping your rate, first of all, I didn't say go buy a house, but if you are and you're shopping your rate, no. First inquiry, an inquiry is when your credit's ran. Each inquiry for mortgage can harm your credit score from 5 to 8 points. Okay, so 5 to 8 point hit, but you have a grace period, meaning you can continue to shop your mortgage for about 30 days before a second inquiry is going to hurt you. During that period of time or grace period, that's when you shop your mortgage. Now, I bring up the credit because in order to get an accurate quote on your rate, you have generally, actually, you always have to do this. In my opinion, I'm a loan officer. You have to let the loan officer run your credit. They have to know what's going on with your credit profile to give you an accurate idea whether or not you qualify for the financing, but also the interest rate. So shop your rate, do it immediately, and know you could probably roughly, there's no science to this, but get a half a point lower than what you guys see on the screen. So a 30-year fix on the upper left, that's conventional. To the right, you see that's a higher interest rate. That's a jumbo. The reason it goes from 6.36 on the left to 6.45 on the right is risk. So any time the lenders feel that there's a risk on your file, they're going to increase your interest rate. But really what they're increasing is your pricing, the price or cost of the interest rate. It's not the interest rates that go up and down every day. It's the cost to get the interest rate. So that's called an LLPA. So anytime there's an adjustment made on the rate, it's a loan level pricing adjustment, or LLPA. Now look at the middle bottom. That's your FHA at 5.92. I could probably get half a point lower, which would be a little under 5.5% right now. So I am shopping for a mortgage, and I am shopping for a house. I plan on probably putting in an offer no later than March of the coming year. And I'm doing that prior to an all-out nationwide home price crash, because I can find, and I'm going to show you guys this later on, I can find deals in my market right now that have wedge in equity and are 30-40% under market value. Does that mean all properties in my market are like that? Absolutely not. Most of the properties in my market are still overpriced, but we use the math to find a great deal. Here's your interest rates, okay? Not a lot of change over the last 2 weeks. It's really going sideways right now. One's got to step back and wonder what's going on behind the scenes. What are they talking about? What are they doing? What are they anticipating? But here's the demand. Here's what the lowered interest rates have done to the market. Okay, let's start with refinance. So here's your refinance applications. These are not closed transactions. These are just people that are seeking a method to get financing, whether it's a refinance or a purchase. So these are just people sending in the application, telling the lender, here's my credit, run it. Can I get qualified? So this is not telling us what's denied and what's approved and what's closed. Only people that are sending in an application. Okay. And there's a lot that goes on between when you send an application is to when you close the loan. A lot can happen in between that denies that deal. And you see that in the denials for refinances surging. But the demand is going up, and you see that with the blue line. So the blue line is the demand for refinances. The orangish line is the trajectory of residential mortgage rates. So you guys see that mortgage rates over the last year, and this is 1 year, I mean, they peaked at 7% and then they went down to about 6.19. So there is lowered interest rates year over year. And it's actually, let's see. So year over year, it was at, I can't quite get there, about 6.6. It's now at about 6.19. So you're talking about a 40 basis point drop. Okay, about half a point drop. And that's why you see that surge right here in refinances. But you guys can see that that's going down sharply, probably because people are realizing that they cannot refinance because they do not have equity. Because remember, you guys, the only people that want to refinance right now, usually the only people that want to refinance right now is the people that purchased in the last 3 years. And the people that purchased in the last 3 years have high interest rates and probably, depending on where they're at, have no equity. So think what I'm saying. Literally, mostly the only people that could even refinance right now are the people with equity, and they have 3, 4, 5% interest rates. So if those people refinance out of a 3 to 4 interest rate, that's not going to be good for the financial situation overall, right? It just depends on what they do. Here's your purchase index. Now, this has barely changed year over year. Here's the year. This is a 1 year outlook going all the way to the left. You see the purchase index was at 154.9. It's now at 186. So it has ticked up as interest rates have gone down. But again, these are purchase applications. It's still in the gutter. Let me show you guys the 10-year, and you guys can see how much lower the volume is. You see the blue lines way up here. So this was kind of going into the lockdowns, and it's crashed down and has not rebounded since. I'm going to do a video a little bit later on Freddie Mac being at severe risk of default. You guys got to see what's going on in the mortgage market. I don't even know how they're still alive, to be honest with you, because there's no business. They literally cannot make money right now overall. The cost to do financing is extremely high and the margins are very low. But let me show you guys how powerful amortization schedules are, because two most important things when it comes to purchasing real estate, other than checking your emotions, right, is your amortization schedule and knowing how your debt works, because debt can be a good thing if you know how to pay it off. Most people do not know how to pay off their mortgage. Most people are just refinancing into a loan to save $150 a month, but they're paying an extra $50,000 in interest to do that. So you got to look at this. Anything you do regarding mortgage, whether purchasing or refinancing, you have to look at your existing amortization schedule, because this is the only way, in my opinion, to get out of the system. If you cannot pay off your mortgage, you cannot get out of the system. Even when you pay it off, you still can't get out of the system, but it's a lot easier to get out of the system because of obviously property taxes and things like that. But here's what it looks like, guys. At a 6.36% interest rate, a loan amount of $500,000 on the 30-year, here's how much money you're going to pay back in interest right here. Okay, so $500,000 loan, you're going to pay back $1.12 million in interest. So that's more than double. So your interest is really over 100%. It's more like 200%, whereas renting is 100%. Now, I want everyone to own, just not in this market, not at these prices, and not at these payments. I want everyone to own because it's the dream of home ownership, and it's usually the best way for families to be successful and have the ability to retire. But what I'm saying is right now is literally the worst time in history to purchase a home. And if you wait, you're generally going to get a better deal. If you wait, you're going to get a better deal. I've waited this whole time, and I see way better deals out in my market than I did in 2022. So personally, I'm glad that I waited. I'm glad I'm on the sideline. Plus, I debanked, put my down payment into silver, and now I have a much larger down payment. So I've protected that aspect of my purchasing power. The things that have been difficult is debt to income ratios. My income has dropped significantly since I got out of sales. But let me show you what happens now when we go to a 5.36. Okay, so we're going to drop this down a full percentage point, and I want you guys to look at the interest, because the interest, although it's going to go down, is still very high. So we're going to go from 6.36 to 5.36. Watch this interest. So we're going from 1.12. Let's see what that goes down to. to $1 million. So you guys see what I'm saying? It's still so at a 5.36% interest rate, low 5%, you're still paying double, right? You're still paying $1 million in interest. So does it help for payment? Yes, it does. Does it help for interest? It does help for interest, but it helps very little. What helps the most is the price. And it also, what helps is making additional payments towards principal. So let's show you, let's do that right now. Okay. So if we don't want to pay $1 million back to the bank, okay, I'm sorry, the total interest is right here. If we don't want to pay back $1 million to the bank, total payback is 200%. Interest is the loan amount. It exceeds the loan amount at 506. But if we don't want to pay the whole thing back, we're just going to pay an extra $100 a month. Let's see how much we save. Extra $100 a month. You save about, so you save 2 years and 4 months and $47,000 for just putting an extra $100. $100 is not too much, but look at what happens when you pay $200. Okay, so it goes from saving $47,000 to, let's see, $86,000, and you turn a loan into about a 25-year loan. So you see how this works? What if we pay an extra $300? So if you can figure out maybe not purchasing a brand new car, or maybe not purchasing a car when your existing car is paid off because you're worried that it's going to break down and you just don't think you can fix it. So if you just like hold off on those things and you don't get more expenses and you put money towards your principal, look at $300. Say you do that hypothetically, $300 more. You turn this loan, guys, into a 23-year and 11-month loan. You save $118,000 if you pay $300 extra. This is a very, very big deal. And this is something that the banks do not want you to know. Now, really important that you guys understand that all we're looking at here is an amortization schedule. We're just looking at principal and we're just looking at interest. That's it. When we look at the full details of your payment, it gets way, way worse. And this is what the loan officers and all these grifters that are selling data never talk about. They never talk about, in fact, their data is completely useless. They cannot generate wedge cash flow and affordability. They can't do it on an individual basis. That's why the macro data providers are shills, and you'll see that at the ending segment of this. I mean, a special thing for Housing Wire, Logan, who's an absolute shill. At the end of this, you guys will see it's a special montage. But look at, here's your mortgage calculator. So I'm going to put in a $550,000 loan, 10% down payment, 30 years, today's interest rate of 6.36. But look at this. We got to also include your taxes, your insurance, and your PMI. So when I switch property taxes to 1.8%, mine's 3.5. Okay, so I'll go, this is more Texas. So if we look at Texas, it's about 1.8, 1.6 to 1.8. Mine's 3.5. So it depends. If it's new, it's going to be double. If it's a new home, 3%. And I'm going to put 1% for home insurance because I live in Texas near the Panhandle and they are bamboozling us with homeowners insurance. So I'm going 1% of the home price. That's probably accurate. Again, if you're in an area or state like me, Texas, Florida, where home insurance is absolutely atrocious. Okay, I go 1%. For PMI, I'm going 0.55%. That also works with FHA and conventional. 0.55 is pretty safe. Now, let me calculate this. So we're going to go to total out of pocket of $1 million over 30 years to, let's see, 1.6 million. Okay, so if I'm renting and say my rent, so first of all, say my rent is $3,000 in this situation. If I buy, it goes to $4,500. So I'm paying an extra $1,600 out of my pocket, hypothetically, right? But here's what I want you guys to understand. And here's why you got to check yourself. You got to put your emotions at the door and you really got to dig into the math because it can be substantially more expensive to own versus rent. Now, I want you to own, okay? I've said that, but I also want you to wait and I want you to find a great deal and I want you to wait for the prices to continue to go down. That's what I want you to do. But if for some reason you can't do that, you have to understand how this works. You guys, your interest and your expense now goes to 300%. So if I'm renting, it's 100%. It's horrible. I don't like that. I don't get any tax deductions except for my home office. So I want to own. I want to live where I own the home. I want that. Okay. But look at 300%. It goes for $550. The home price is $550, but over 30 years, I pay back $1.6 million. Okay, so it's not a slam dunk. We got to take our time. We really got to think, do I want to stay renting right now? Is it just a mindset? Am I depressed for no reason? Do I want a house just because society is telling me I want a house? Is that why you want a house? Or do you want a house for some other legitimate reason? I don't know. Every situation is different. You got to really take a step back and be careful who you listen to because, again, look at what you could be trapped into. So if I go from $3,000 a month to almost $4,600 a month, that's not good. What if my AC breaks down? What if the foundation has issues? There's so many things here that people need to take into consideration when purchasing a home. And I'm worried, I'm terrified, you guys, that most people, maybe not all people, but most people are not doing that. So we're going to go into a video here in a second. I'm sorry, that was a long-winded rant. As you guys can see, I just need to get back into doing live videos. I've missed you so much. I've missed my ability to talk to each and every one of you and to correspond with you. And if I can't do that, I don't want to do YouTube anymore. I want to be able to talk to you guys and know that I'm helping. If I don't know that I'm helping, I am not motivated to keep doing this. So just let me know I'm helping. That's all I need from you guys. You guys uplift me. And having said that, okay, so we'll go into the Walmart video now. This is going to be from Walmart talking about how they're trying to keep their prices. This is Walmart, okay? They're saying that their margins are 4% and that they've rolled back 7,000 items because grocery inflation is 25%. And they're mad. They're mad at President Trump, okay? I don't like politics. I'm not going to talk about him, okay? Because in my mind, again, it's an illusion of choice. And really what it does is it just creates division. So we're going to go into that video. I'm going to do my first timestamp, and then I'm going to go back to look at the comments, and I'm just going to talk to you guys. I'm going to just chat it up, and I'm going to love on you. But first, let's watch this video. Let me know if you guys can, that the audio is okay.
You know you have to go, you're ringing the bell, and you've got some things you have to do upstairs. But very quickly, can you just give us kind of a heads up of where the consumer is right now? What are you seeing? You all have talked about how you've seen people who make $100,000 and more coming into the stores. What do you see at the lower end?
Yeah, as we said when we released our third quarter results, it's been really consistent for us. Now, we're benefiting from some share gains. People with higher income levels are shopping with us more often and have been for a while. There's pressure at the bottom end. Inflation being low single digit right now helps a little bit, but it's on years of price inflation in some categories. Gas prices being low is helpful right now. So people are behaving pretty consistently, but there's pressure for those at lower income levels.
Yeah, I think in the store, you've seen 1.3% inflation versus closer to 3% for the rest of the nation. But that grocery store inflation, 25% over the last 5 years.
Yeah, that's a sticky problem.
Yeah.
Right now, we've got over 7,000 rollbacks in Walmart US, and our team has done a fantastic job of figuring out what to change, whether it's in food or it's in general merchandise, to try and keep prices down. In the apparel office yesterday, they were giving us examples of how we've been able to improve quality, change country of origin, move a factory, and end up with a better outcome. Lots of flexibility on their part, and they manage our inventory so well. You know, when this year started and we were facing this tariff situation, the biggest concern I had is that we would get over inventoried, but they've navigated that. Our merchants have so well.
I mean, with your margins, what are they now?
It's tight, like 4%-ish.
905 billion. I hadn't looked at it in a while. You're going to be $1 trillion retailer. That's just staggering that you can do that.
The business model's changed with income from membership and advertising and some of the other things we're building. The composition of the income statement looks different.
Yeah. Doug, you have been a phenomenal leader, not just for Walmart, but I think what you have done at the Business Roundtable and kind of speaking out for American values. And we want to thank you for that. I can't wait to see your next chapter. What are you going to do next?
I don't know. I'm going to ask Shelley what I'm supposed to do.
We think it's going to be big.
You don't mean CNBC contributor.
Well, I mean, I know you're working on
I
that.
don't want to say that much.
That kind of visibility.
I don't have that much to say.
You don't. Yeah.
I'll leave it to you. Seriously, I've learned a lot from you guys over the years. In the pandemic in particular, you were very helpful to keep us all educated, and I'm grateful for the role you guys play every day.
But you're thinking about what to do next. You're not going to do anything for a little while.
It'll be some combination of business and philanthropic stuff, but I'm going to take a few months. I've never had a blank calendar, and I've now seen what one looks like in a few months, and it's kind of exciting. And then we'll see.
Well, we hope you enjoy your time off, you and Shelley both. And
Did you guys like that? What did you think of that video? Was it helpful to watch that video? Let me know what you guys think. Real quick, and then we're going to get into the housing market. We're going to do an analysis. That analysis will be uploaded onto the website under the How to Do a Market Analysis class. I hope you guys are taking that class. You got to stay sharp in this market. So keeps taking the courses that I'm creating for you. If you can't, go back and watch it as well. I need you guys to stay active, to stay sharp. Trust me when I tell you that, because when rates go down, prices go down, and you've been on the sidelines with great purchasing power, I'm telling you right now, you're going to lose control of your emotions. Okay. So please, as you're out right now, keep learning. It doesn't cost you any money. Okay. So just do that. It's going to be uploaded. Now, Crystal, I wanted to talk about this comment. This is a good comment. A lot of people are confused about property taxes. She's saying, try liquidating real estate into oil derivatives and then ask yourself why oil Oil. See, I can't even talk. Oil doesn't come with property tax. Here's the thing that's crazy, Crystal. Yes, it does. And here's how. Okay, so think of where they store the oil. So if they store the oil in a tanker on land, that land has property taxes. When they go and they distribute gas at the gas station into your car, that gas station has property taxes. Property taxes, at first, when I was working with Mitch, and I've been working with Mitch for about 14 months, when I first was working with Mitch, I didn't fully understand how systemically embedded property tax fraud was. I knew it was an issue, but now looking back, he was right the whole time. Literally, there is so much debauchery tied in to property taxes. It's hard to explain. There's so much fraud and corruption surrounding property. Think of how much money they take. It's some states, most states, that's their biggest source of income. So obviously there's fraud, and we've found the fraud, and it's a pattern of practice. And honestly, everything has property tax built into it, because again, the tankers, wherever they have to keep those, if they're storing trucks to transfer the oil to the gas stations, wherever they're storing trucks, property taxes, where they're distributing gas, property taxes, where you park your car, property taxes. There's property taxes hit everything. It's absolutely despicable. But thank you for that comment. I thought that was extremely helpful because we want to keep talking about it. Let's go into our housing market update right now. And again, this is going to be uploaded as well into our course. But before I get into that, I want to show you guys, and I want you guys to understand what I'm saying. And this is something that bulls or shills, I would say, and bears, or people that are honest, share in common. Both sides, regardless of what you think is going to happen in the housing market, both sides know that it is, from a price standpoint, the worst time in history. From an income perspective, a fundamental perspective, fundamental being the income growth, it's never been a worse time to purchase real estate from a price standpoint. The best way to show that, in my opinion, and you can't really see that because there's comments, is looking at the Case-Shiller, which is a methodology used basically showing you guys the trajectory of home prices, the value of home prices. That's Case-Shiller. I don't like methodology, but that's what they're using. And then they're going and using CPI. Okay, so we're looking at CPI, which is kind of like purchasing power. And the red line is CPI. I'm sorry. The red line is home prices for Case-Shiller. You see that up here? The bottom line, black line, is CPI, or purchasing power. And I want you guys to understand the divergence, meaning it is way more unaffordable from an income standpoint to purchase right now than it's ever been, including in the 70s and 80s when they were fighting inflation. Okay, because people are like, yeah, same amount, portion your income went to your mortgage back in the 70s and 80s. But back in the 70s and 80s, we didn't have this mountain of debt. We didn't have subscriptions. We didn't have cell phones. We didn't have all buy now, pay later, massive credit card debt. We didn't have the situation we have today. People are drowning in debt. You see that here. Look at the divergence doesn't really happen until, look at right here, the late mid 70s. And then it kind of starts to diverts again right here in the 1990s. And then during the dot-com bubble. Look at this. So from a price standpoint, we need to know this right away. It's the worst time in history. That's why we need nationwide deflation, which we are getting, but it's not shown in the data for one reason or another. Now, it's not just prices, guys. It's also payments. So we have horrible prices. We have horrible payments historically. Look at this. Affordability today. This is Zillow calculating debt to income ratio. First, let's look at 2006, July. This was the peak of unaffordability during the global financial crisis. Debt to income ratio basically means how much of your income goes towards paying off your debt. Property taxes included. And that's why I like this, because it's including property taxes and homeowners insurance. Most affordability calculators that you guys see for mortgages do not count property taxes and homeowners insurance, which is really important to calculate because there is a crisis going on right now, especially where I live in Houston. We get hit with all kinds of stuff in Houston, property tax and homeowners insurance, hurricanes. Okay, we got massive hurricanes here. So it peaked in July 2006 at 42.7. Okay, fast forward to today. Whoops. Let's see here. Okay, let's go back to, what is this, 10% down payment. Let me go back. I'm sorry, guys. And I suggest you go here. If you want to go here, just type in understanding housing affordability and Zillow, and this will come up. So fast forward to what happened recently, October 2023, it peaked at 45.9%, meaning the payments are more bubbly than during the peak of the global financial crisis. And right now they're 39%. So kind of close to the peak, you see. but they're still 39%. That's been going down, not necessarily because home prices. It's been going down a little bit because of interest rates and home prices, because you're not going to have a drop of 7% DTI for a half a point reduction in interest rate. There's other factors at play here, but regardless, I thought that was very interesting. And look at how much income is needed to qualify for your typical home. And I doubt this is accurate, but they're saying $111,000. Comment below if you make six figures and, well, actually, we can still afford a house. Some of us can still afford a house. We're just choosing not to. Okay. So before I go into the market analysis, what I've showed you is why I'm saying right now is one of the worst times to buy a home in history. I'm showing you the data, the sources, and why I'm saying that. Again, it's ungrounded from income. We just cannot afford to buy these houses. All right. Now, what we're going to do is we're going to use the math to learn how to buy real estate. I'm not saying buy real estate, but what I am saying is use the math when you do decide to buy real estate. So I'm going to go to realestatemindset.org, just like you guys can do. By the way, I have updated videos on here. Here's my updated page. It's a lot cleaner, and I've categorized everything on the top right here. So we're going to go to home buying. So we'll click home buying. And then what we're going to do, look at, and I have a video right here. So you watch first. We're going to scroll down here. Now, remember, I'm going to update this later, the how to do a market analysis course. This is an actual class you guys can take. But more specifically, I'm going to download this form right here, and we're going to fill this form out to see whether or not we're going to be able to get a good deal. Here's what the form looks like. We're going to do a 1-year comp analysis right here. Now, I'm going to use this right here. This is MLS. So if you're a realtor, you have access to MLS, probably Matrix. Now, when I don't filter the data, here's what the market looks like. All right, this is Kingwood. There's way too much. There's too much noise here. I don't know. I don't want to go through all this. By the way, remember 3 years ago when I had like 68 listings? Now I have like close to 200. I have like 4. So thank God I waited, right? If I didn't wait, I would have to settle on a house, but now I don't. And I couldn't negotiate with the seller. Now look at this. They're negotiating like crazy. All of these are negotiating. Most all of them are negotiating like crazy. I'm so glad I waited. All right. Now, I still made offers because I found pretty decent deals here and there, but overall, I'm glad I waited. But look at, okay, you don't want to look at a market like this. But what I'm showing you is the raw data before I filter this. Too much stuff. This is just Kingwood. Too much stuff. Okay. So I go back. Excuse me. I go back here. I got allergies today. Okay. Let's go back right here. We're going to access MLS. All right. And like I've been showing you guys, and if you're a realtor, please do this with your clients. Your clients will love you for this. Clients do not want to hear your cheerlead. They do not want to hear how great a time it is to buy a house. What they want to do is they want to understand how to interpret real estate, because realtors are not doing that right now. Okay. So this is what you need to do. If you're a realtor, they will love you for this. This is the biggest benefit as a realtor that you can give to your client. Okay, raw data analysis. So all I'm going to do, if you're a realtor or not, I'm just going to categorize and filter the data out by $80 to $100 a square foot. And that way, I know for the most part, not all of the time, but for the most part, anything I look at now should be well under market value. So let's go back to the map. Okay, so instead of 100,000, right, because that's what it was before, instead of 100,000 listings, let's look. Look at this. Do you remember how this was littered before? Remember that? They were everywhere. So what I've done is I've condensed that because I don't want to fall for the trap, which is home ownership. I only want to buy and purchase real estate that I know is a good financial decision, because I've learned how to enjoy myself and love my life even as a renter. Because life is about more than just owning. Should we own homes? 100%. That's my opinion. 100%. I've always been bullish on real estate. The only time that I flipped to be bearish on real estate is over the last 3 years. My entire 20-year career, bullish, buy now, buy now, right? But that stopped. And there's a reason why. And I showed you why. But look I don't have to listen to the noise. I could just use the math. That's why these data providers can't do what I just showed you. This is the ultimate tool. You look at raw data and you analyze it by using math, simple math. So let's look at this one. Okay, we'll do an analysis on this one right here. Again, you guys can come back to this, and this is an analysis on the Trailwood Village. I think I've done one of these before. So what we got to do, guys, is we got to go hyper local. So real estate is about hyper local analysis. Okay, so there's only which means you want to do an analysis on the subdivision. So the housing market is the subdivision. Did I not? Here it is right here. Let me move this over. So first, let me copy and paste the subdivision here. Okay, then I also want the purchase price. which is 350. I want the size of the house right here. And again, I want the subdivision here. So let's put the 350 and size of the house. So it's 4024. 4024 purchase price. Isn't that crazy how you could buy a 4,000? It's still too much. The property taxes are brutal, right? But my God, that's cheap, right? I mean, if we didn't have to pay property tax, would you not want to buy this house? I want to buy this house with the look at this. Oh my God. So they redid this too. Look at, so they redid this house. Gee, it's not a bad house. I may walk this house. I'm gonna go walk this house later today. I told you I'm in the market. I'm looking right now. I'm gonna go walk this house. Okay, it needs a little bit of repair. Look at that. See this ceiling right there? So it looks like it's a little bit dirty. I don't care for $86 a square foot. Dang, this is a good one. Okay, so on paper, it looks good. I got to be careful what I say, but let's go to the taxes now because we also need that. Okay, so we're going to go to the taxes now. We're going to figure out how much the taxes are. Holy smokes. Okay, so the home is for sale for $350, but it's assessed for $474,000. So this is assessed for $124,000 over market value. So you could literally mathematically, quantifiably show this person and anyone that's watching that this city is ripping these homeowners off. They're literally fraudulently robbing them. By law, the CAD needs to come up with an accurate, fair, honest value. It's not 474, guys. They can't even sell for 350. But again, what I'm doing here is I'm highlighting the tax liability, which is 11,180. I go back to the form here. I put 11,180. Okay, so that's my taxes. So I pretty much, okay, I'm gonna put 12 main. Okay, so I have all of the details. Anyone could essentially do what I just did. The hard part now is looking for the market home value price per square foot. So that's what we're going to do now by looking at all the homes that sold over the last year in Trailwood Village. Very, very easy to do this because, again, where it's hyper local. So we're going to go back to search. We're going to lock it down to only looking at that subdivision, Trailwood Village. We're going to look at sold properties over the last year. 365. Okay. It's going to give me 39 homes. Let's go look at results. Now, I believe in the raw data. Okay. But when I'm doing my analysis, I'm only doing an analysis on properties that have a 500 square foot variance in size. So if the size of the property I'm doing an analysis on is 4,000 square feet, then I only want to use comps that are 3,500 square feet up to 4,500 square feet. Okay, so this, let me go by size. So I'm going to categorize this by size right here. All right, now actually I'm going to go the other way. I'm going to go highest to lowest. Okay, so you see that we don't have a lot of comps. So the subject property is by far the biggest property in that subdivision. That's not good. So what I'm going to do instead, I'm going to select the first 5 comps, the 5 biggest homes. And you guys see what I'm saying? This is hard to do that because look at this is huge differences in size. And look at the price per square foot. The price per square foot is all over the place as well. It's $91 to $146. But I'm going to select these. So in other words, we're doing the gross wedge. More research would have to be done, right? But this is a great way to start. So let's just take the first 5 comps. Let's add it all together and divide by 5 because that's how many comps there are. Gives us the market square foot of $115.32. So I go back to the form and I put $115.32. And that's all it takes. That's literally all you have to do to figure out what the wedge or how much under market value a home is. It's very, very, well, you got to do the math, but this is all of the inputs that you need here. Okay, so I'm going to pull up my calculator. Again, Zillow, Redfin, Housing Wire, they can't do this. So if you're spending money on those services, I don't know why macro data doesn't work. You can't do what I'm showing you with macro data. You must use raw data. You must have access to homes that have already sold. So what I'm going to do is take the market price per square foot of $115.32. I'm going to multiply that by the size of the house, which is 4,024, gives me the market value, right? Whatever that means, of $464,000. Okay, so I'm going to reduce now the purchase price, which was $350. Means that I have a wedge of $114,000. Okay, but I put gross wedge because I may have to put work into the house to bring it up to code. So if I have to put $20,000, $30,000 into that house to bring it up to code, then that means I have to subtract $30,000 from the 114. So does that make sense to you guys? Let me know. But either way, you got about 20% of wedge. I'm looking for 30 to 40% wedge for obvious reasons, right? But this property specifically, you got $114,000 in wedge, and that is going to conclude our market analysis for today. And on Friday, because remember, you guys, I'm going to show you, I'm going to be here for you. I'm going to be here Tuesdays and Fridays to the best of my abilities. I'm starting early today because there's the university that we stayed at. We went to Kerrville for the July 4th tragedy, the flood that happened there, that the university that we stayed at is going to interview me today about what we witnessed. And I'm really glad they're doing that because I have so much locked in about what happened. I haven't even talked to anyone about Helene. Like what really happened to Hurricane Helene. I mean, it's traumatic, guys. But anyways, I'm going to do that a little bit later today. Let's go into our next video now, which is the Fed. It's about the Fed and their tone on what, basically they're just going to guess what the Fed's going to do next. I know it's kind of useless. It is what it is. I'm going to put our timestamp right now, but let me know what you guys think. I'll be back in the comments and let me know the audio's okay.
Let's talk about it all with Kate Moore, Chief Investment Officer at Citi Wealth. Kate, good to see you again. How relevant, if at all, maybe it's not, is this Federal Reserve decision on Wednesday?
Look, it's super relevant. I think we can agree that everyone in the market is watching this and that, participants, whether you're equity investors or multi-asset investors or rates investors, are really concerned with the tone of the Fed coming out of this rate decision. Not so much the action itself, but whether or not we get a hawkish tone or more of a dovish tone. And look, I firmly believe that when looking at the economic data and the third-party macro data that we have in front of us right now, it is a little bit of a choose-your-own-adventure. You can pick the data points and the story that you want to tell. You can data fit your narrative. And we're interested to see how the Fed does that and how they weave through what are often conflicting bits of data on both prices as well as labor to make their assessment for what future moves may or may not look like.
So what, are we paying more attention to the decision itself? 90% chance of a rate cut, according to the CME's FedWatch tool, Kate. Or are we paying more attention to what the Fed may say about the future, especially given that Chair Jerome Powell, he's only going to be chair for another couple of meetings and another couple of months? Is there one way to handicap which one might be more valuable or important than the other?
I think without question, Brian, that the focus should be on the tone of Powell's presser and then what happens after the Fed meeting, both in terms of, the speakers that come out in the following weeks, as well as the inflation data that gets released, of course, after the FOMC decision this week. So it is not just the statement and it's not just the action. I think we kind of understand the direction of travel there, but it is really the tone out of both Powell as well as the rest of the Fed speakers who will come out and talk to us as investors and talk to the media following that when we get a real sense for where the debate was in the committee. And you've made this good point, right? Powell only has a few meetings in theory left. But we do know that there are a bunch of other voters who have had a variety of different views. We know this from the minutes. We know this from the comments over the last month or two. And we think the debate is going to be very strong into the first part of 2026. And that people who are expecting a consistent pattern of rate cut after rate cut in each subsequent meeting are going to find themselves disappointed. In our view, nominal growth is going to be solid in 2026. Inflation is a little bit spicier, I think, than the average person may want to admit. And by the average person, I'm thinking about members of the administration, not so much consumers who feel this in their day-to-day purchases. And that the labor market, while frozen, is not deteriorating at a massively rapid rate, suggesting that we don't need a slash and burn rate cut policy ahead of us. So I think it's going to be difficult for the Fed over the next couple quarters to make decisions, and that the debate is going to be very important, not just the signaling at this meeting.
You guys, I'm sorry you had to watch that, but it's important. This is what they're saying. I mean, we get it now, right? Like they don't know anything about us, right? They're just lying to us. They completely out of tone. How is the job market still stable when we have the worst job cuts in like forever, and we've never had this many job cuts like before recession. So what are we in now? And then look at the areas of default. We have close to $3 trillion in consumer debt that's in default. Commercial mortgage-backed securities in default. Refinance denials skyrocketing, meaning that even with loose credit, people still can't get loans because the tightening credit is the price. I mean, look at what we have. Look at the deficit. How could you explain the deficit if we're not in a recession? The deficit is skyrocketing as if they're fighting to keep us out of depression. No one could take that away. Those are facts, and we see that in the data. If it was not for the deficit and AI and inflation, we would be crashing and burning right now. I think we can all admit that, right? And most people that are bullish on everything could admit that about the Bank Term Funding Program that was created in 2023 when we had those bank runs. Remember those bank runs? Remember that? They had to intervene. Our economy will naturally deflate if they just stop stimulating it. Our economy is now created in such to where it's going to crash naturally. They must continue to kick in quantitative easing, or rather, the fraud is the only thing holding everything together. It's the fraud that's holding things together. And the crazy thing about all this, guys, is they need more fraud. It's not going to be less. Things are going to get worse until they break. Look at what's going on with property taxes. These cities, they're not decreasing their budgets. They're increasing their budgets, not decreasing. So unaffordability is just going to get worse. Utilities, power, it's all going to get worse. And that's why I'm rallying. And I'm going to show you that stuff in a second. I got your message. You couldn't find that, but we're going to do a market update first. And then I'm going to show you guys where that rally is going to be as well. Let me tee this up real quick. So we'll do our market update. Let's see where we're at. Okay. So let's just look at the 1 week. So we're going to look at the various indexes, look at the 1 week. I've decided, first of all, I didn't want to be necessarily an investor. I just wanted to have a happy, balanced, normal life. But I bought metals. That's where I'm going. Metals, all right, to be honest. But let's look at the Dow right now. Okay, let's see. We on the futures. So Dow sideways, but look at what happened over the last 5 days. So it's kind of switching a little bit. I just want to look at the 5 day. On Friday, we'll look at the 1 month again, but over 5 days, the Dow's up almost 1%. Okay, so we got a little bit of increase with the Dow. Let me show you guys now let's see here. Here we go. The S&P 500. S&P 500 over 5 days is up 0.33%. Let's look at the NASDAQ. So the NASDAQ, same thing, 0.84% over 5 days. So look at over a month, though. It's down over a month. Not a lot going on in the stock market except volatility. Look at gold. Gold didn't do much over the last 5 days. Gold is actually down almost a full % over 5 days. Plus, you would pay a premium, so it's that's about, just depends on who you buy gold from, 3 or 4%. It just depends, but down 1% over 5 days. But look at over 1 month, 2.4%. Over 1 year, 57%. Let me show you guys silver now. Silver over 5 days is the winner out of all the indexes I just showed you. It is up 1.37% over 5 days. Over 1 month, up 17.55%. Let's see what it's at right now. Whoa, we're going to hit a record today. Comment below if you guys think we hit $60 today. $60 would be a new record. Are we going to hit that today? We're not going to hit that today. Silver has been on such a tear. It is incredible. I felt like I almost purchased perfectly at $29. So remember, there's a downdraft, and Mitch was like, you know what, just get in and then slowly get in. It was at $29. We've literally watched silver skyrocket this entire time. Absolutely crazy. And that's another indication of like a recession or depression. This means things are bad. And I was like, all right, things are bad. Let me get some silver. Oh yeah, they're bad. It's skyrocketing up. You guys see what I mean? You don't have to do it, but a mindless rock outdid all of these professional financial advisors and all of the indexes and markets. Now look at Bitcoin. Bitcoin over the last week is actually up more than silver and gold for the first time in a long time, up 2.17% over 1 week. Bitcoin at $90,000. Pretty interesting. Look at XRP. XRP up 1.21% over a week at $2.06. Still down substantially over the last month. Volume looks like it's down over the last 24 hours. Dang, volume down 24% over the last 24 hours. That's interesting. I got a little bit of XRP only so that I could kind of just experiment. It's a very, very small amount. I just wanted to join the party and see what everyone was talking about. And then also I want to put my money where my mouth is. And I've heard for Mitch this entire time how stupid of a move that is. So because I bought XRP at $3.10. But again, it's very little, right? It's just a tiny little bit of XRP at 3.15. So I could tell you guys so far, horrible decision. So I can literally say that now because I've lost a little bit of money, but a high percentage I've lost because it was at like 3.10 or 3.15. So just buy toilet paper. Oh man, Austin, what's up, brother? It's so nice to see you. Austin, I'm so sorry I didn't respond to your text message, man. I have been drowning. I am proud of you. I got your message. Be safe out there. You scare me, brother. You scare me. I know what you're doing. Don't tell people what you're doing. I don't want that type of smoke on this live, but I am proud of you, man. I do love you. He called me the other day. He's like, Travis, I think I found a house. Okay, I don't have to pay property taxes. I'm a veteran. I could do a VA. He's like, Travis, it's time. It's a new build. I was like, all right, brother, what's the wedge? Austin, what's the wedge, right? Where's the wedge, Austin? There was no wedge. There was no wedge, Austin. There was no wedge, meaning it wasn't really under market value. Am I right? And he decided not to buy. I appreciate that. But I mean, ultimately, it's his decision. But we talked for a while. So I think you did the right thing, man. What are you in a rush for? Look at, he said we didn't buy. Look at, good. So yeah, exactly. I mean, because there's like, what do you wait all this time and you're gonna? I mean, it was some kind of good deals but they finagled him to make him think it was a good deal. When we looked at the numbers, it wasn't even that good of a deal. So it's like, what's the rush? You're doing great right now, Austin. You're doing great. You're succeeding. You're saving money. Your career is blossoming. Your family is growing. Why do you want to run into something? And it was an expensive house. You know that. You didn't need that expensive house, sir. You didn't need that. All right. And I also promised him that if I ever help him with a house, I'm going to use my commission to get him a better deal. Let's listen to Ray Dalio now and see what he has to say about the market. He's going to talk a little bit about the Middle East, but it's very interesting. Listen to what he has to say. Then I'll get you guys out of here. Let me know that the audio is okay.
Of events coming up through the course of this week, and Abu Dhabi is going to be bringing in something like $63 trillion worth of asset managers through the course of this week as well. So a lot to keep in focus, but key on the agenda this week is AI. And this is one of your 5 forces that you like to talk about. So I want your take on what's happening with the AI trade right now as well. You have said that we are in bubble territory, but investors should not sell. Can you expand on that for me?
Well, I think there's the investor perspective and then there's the user perspective, right? I think it's important to distinguish the fact that this technology will have, without a doubt, revolutionarily beneficial impacts. That has nothing to do with a bubble, okay? All the bubbles took place in times of great technological change, a lot of money going in. It's never done precisely. It's either going to be too much or too little to make the profits. And then there's just this big up and down. A bubble is a set of circumstances where, for various reasons, the buying and the selling are unsustainable. Those who buy for their various reasons, whether there's debt in there and all of that. And then there's the pricking of a bubble. Okay, very important to make a difference, to understand the difference. So as a bubble is arising, you don't want to get out of it just because the bubble. You want to look for the prickling of the bubble, the pricking. And that usually has to do with the tightening of money. Whatever the force is, you have to realize that wealth is different from money. In a bubble, it's very easy to create wealth. You know, like nowadays, you can...
You guys, I just wanted to make a point real quick. And this is why I think we're going into depression, not a recession. He's basically saying the bubble pops with tightening money. What has been tightening right now? It has not been credit. So we don't have tightening money in the form of credit. We have tightening money in the form of maximized prices, meaning that people can no longer afford to buy things even with the very loose credit. And they're making it even looser. I mean, Trump just comes out and is like, we're going to deregulate. We're going to deregulate. Great. We're going to have more inflation. Good job on that, right? Keep inflating the bubble. Keep disregarding that mom and pop have to pay for this, and we're suffering right now. We're suffering right now. They have literally capitalized and stolen our communities and the American dream, and they're hurting our families. This is absolute debauchery. But think about that. The credit tightening and money tightening is not in the form of guidelines yet. So when that starts, it gets even worse, meaning that so they'll tighten credit, but even when they loosen credit back up, many of us can't even participate. We can't participate. We're losing our jobs. I have personally lost a lot of my purchasing power. And granted, it was a result of going into the field for too long, right? So I lost a lot of money going into the field too long. But regardless, you guys, it's wicked out there. So think about it. It's a huge systemic issue, and they're disregarding you and I.
Raise $50 million for a valuation of $1 billion. You are now a billionaire, and that's worth $1 billion on paper, but it doesn't mean you can sell that. And so when you get into a situation where the wealth has to be sold to raise money, typically maybe for debt service payments, but things like wealth taxes. Can you imagine if a wealth tax came over? Then you would have that kind of dynamic. So we're not going to have a tightening of monetary policy soon, and so in fact an easing. So you start to see these cracks. We're seeing cracks in the markets in a number of ways: private equity, venture capital, debt that's being refinanced, and all of those. So we are in a bubble, I believe, by almost all of those measures. Not the most extreme bubbles, quite similar to 2000, but not at the same level, not the same level as the 1929 bubble, but we are in that bubble. And then the question is, when does the bubble get pricked? Because wealth has to be sold to come up with the money to deliver it for whatever it's needed.
Not just when the bubble might be pricked, but what will it be pricked by? You've outlined some concerns. What would you say is the biggest risk right now to the momentum that we're seeing in the AI trade?
Well, you're seeing cracks in venture capital, private equity, real estate. You're seeing that interest rates on locked-in debt are now not going to exist. In other words, debt is now maturing, and that means that it has to be rolled forward. And that'll be rolled forward at higher interest rates. So that's going to create a cash flow for a number of entities in those areas. They are also the owners of money that's going in there. I don't think we're going to have a tightening of monetary policy immediately. And so that'll be neutral. And then I think the real interesting question is a wealth tax question, because the wealthy are getting much more wealthier, but at the same time as that wealth is not taxed. And there's a lot more talk about that at the state level or at the federal level, less so. These are the signs, the early signs of needing perhaps to sell wealth to deal with some of those expenses. We also have a very concentrated market, right? Around AI, around a limited number of shares. And we also, with these wealth gaps, we have a lot of the political problems. As we go into the 2026 elections, it's likely that the Republicans can lose the House and so on. You will see a lot more conflict in different ways. And also that we have the higher interest rates. So the future, if I was to say the next year or two in the future, is going to be more precarious.
Ray, if you were running Bridgewater today, how exposed would you be to some of these AI mega cap names?
Well, you have to bet on that. I would bet also more on the usage of it. In other words, there's the hyperscalers and so on. But the greatest impact is going to come from the users of it. So those who have the platforms for enabling, or those who actually use it to change their cost and their effectiveness, will be the real beneficiaries. They're not expensive like that. But I also know that I have to have diversification. Diversification is very much important. And we're right now in this situation where so much is concentrated on so few. And so that is a particular problem. So I'd be much more diversified. I would deal with that impact. I would also deal with the issue of money. So when you ask how I would be positioned, I think the real question is, what is the value of money? And the value of money is the reciprocal of the value of debt. In other words, debt is a promise to pay money. So you're holding a debt asset. Those are going to give money. We have a problem. We don't have enough money. We're in a situation where, for combination of budget deficits around the world, military expenses, other expenses, social expenses, have created a dynamic. So I'm anti, I worry about debt. Okay. I worry about the issues of debt. That means that I want fiat money. I'm concerned about fiat money. That means that I also would be positioned in not fiat money, gold positions, and so on. So that would give you a flavor of the mix of markets that I'm in and would hold.
I just finished developing.
All right. So I got some cool stuff to go over with you guys now. A little bit personal, and I want to go into some questions as well. So I'm going to just mark this as our conclusion, and I have to kind of hurry because I have to do that interview. Now, I want to, oh, dang, Charles, what's up, bro? I was wondering, so we're only missing, who are we missing? Christy. That's it. We're only missing Christy. So let me first show you guys, I had a question about this. So I want to first show you this, and then I want to show you something I've been doing on YouTube to test this AI out, and I just want to show you guys the results. If you guys are interested to do something yourself like this, because you may be able to make money, and that's why I want to show you. I don't know yet because I just haven't had time. I'm doing so many different projects. I'm trying to find this. I'm gonna set it up for you guys. Give me a minute, and then I could show you how. Because we started using AI specifically because my wife's been helping a little bit as well with editing because I've been so burnt out fighting and creating all of these templates and stuff. So she's been helping. But she's also kind of been playing with the AI to analyze like articles about the economy and things like that, and testing it. And so I'm trying to find real quick where did it go? Oh, here it is. Okay, cool. I found it right here. All right. So let me start first with this. Okay, so this is, let me pull this up right here. Okay, boom. So as far as the rally, all right, this was for Tom, I think you asked, or Scrog. Okay, here we go. So Scrog, all right, here it is. Now, if you want to know more about this rally, you can go to the I Love Conroe page. It's the bigger page. It's the bigger page, Scrog. And if you go here to I Love Conroe, this is the one at 227,000 people. So it's the bigger I Love Conroe. You can just click my name or type my name, and this is going to come up right here. I didn't make this. The business owner made this, who's a noodle shop. Is actually a noodle shop with the Dragon Ball Z theme. I thought it was pretty cool. But this is the protest right here. So if you want to come, you want to join us, man, I'm going to be there. I'll be at the shop at probably before 8 a.m. And then we're going to march to where the council meeting is. And then we're going to talk at the council meeting. So if you want to come, man, you want to support the community, Scrog, because I know you're in this community. And if you can afford to do that, you don't have work, please do it, because it's a great opportunity for us to show everyone else that this is what mom and pop do when we have issues. We work together. Doesn't matter our race, doesn't matter our political affiliations, our financial standing. We work together. We are team mom and pop. And when someone has an issue with the government, they're willing to step up and stand up. Well, we stand up with them. And so that's why I'm going there. I don't even care about this fee because it doesn't pertain to me. I don't have to pay this fee because I don't have a storefront and I don't have a business. But again, I love my community, and I'm sick and tired of mom and pop doing nothing. So I'm not just going to do nothing. I'm going to go there, I'm going to record it, and I'm going to show you guys how things are supposed to work. So it's right here. Go there. Now take a look at this. This is an AI channel that I have 9 subscribers. This is a channel that I made just to test AI. So if you guys wanted to kind of just check it out, I'm just playing around with this. I haven't put too much time in, but I just wanted to test the AI technology. So I made this channel. It's called Tower 7 Media for obvious reasons, especially if you know about Tower 7, then you know what I'm talking about. Oh, dang. Okay. And so what I did is like some of the articles that Mitch wrote, I just dropped an AI, like property tax is intent to defraud. And we made a video, and it took like a minute and a half to make this, to drop his brilliant article into an AI called Steve AI, and it created this video. Now, I wanted to do off niche stuff. So I really kind of went into like the declassified stuff with the CIA, like Tether, Tower 7. But what I really, and then obviously repealing property tax, but what I really love, I love this ancient civilization. I love it. Oh my God, I love this stuff. Now, I honestly, I find it brings me closer to God. Personally, it doesn't scare me, but there are some amazing, look at that. I got 162 views on that, 121 views. These are doing pretty good. 93 views, they're doing pretty good. But I made all this with AI and it took like 10 minutes. And I just wanted to show you that. It's just interesting to see what happens. I'm not saying to switch to AI. I'm just testing it. Now, a couple things I wanted to tell you guys about and talk to you. Here it is right here. So this is a comment from Ben. Do you see rent going up, remaining stable, or decreasing from market correction? Here's the thing. I would be a fool not to say this. And I would be doing you an injustice. It depends on the market. It depends on the market. So if you're in a market like that's right next to the next SpaceX and there's a flood of 10,000 people in and only 2,000 rentals, rent's not going to go down. It's going to go up, right? Because there's too much demand, not enough inventory. Even though the affordability factors are sky high, there's just going to be, it's a flood of people. So overall though, 100%, I expect rents to go down more in line with median household income. More meaning not to median household income, like down more to median household income for a couple reasons. Number one, affordability, primarily. But number two, inventory. They have been building an overwhelming amount of multifamily construction projects. And those multifamily construction projects right now are suffering. The default in those is outrageous. And the reason it's defaulting is they can't get enough rent to offset the cost of building new because people can't afford it. And so you see the defaults, you see rent going down. But the thing is, rent has already been going down. They've just been covering up the data with incentives. So if 1 year rent's $2,000, but the next year it's still $2,000, but they're offering 2 free months of rent, you got to take $4,000 off that. So it's not really $2,000. You just missed 2 rent payments over the year. So that's their way to finagle the data. Plus they're using AI, but I 100% think, and that's saying a lot. To have rent drop when people aren't purchasing and can't afford to purchase homes is saying a lot, right? Because normally when the housing market is bad like this, rent's going to go up because people can't buy, which leaves it to where they can only rent. But things are so bad right now and people have been renting for so long. Again, the inventory, all the things I mentioned, median household income, I think that rent is going to continue to go down. And when we look at Zillow rent, as far as our last month housing market, rent was going down. So very interesting to see that. That means that the fundamentals aren't there. So, okay. So their comment was Path is a cheap, profitable AI company. That's why I brought that channel up, just to show you guys you can literally do it on the side. AI is not what you think it is. There's so many problems with AI, but it is very helpful for the right people. If you're doing certain tasks, I'm telling you guys, AI is not perfect. It's compared to how they're hyping it up, it's a freaking joke. Okay, it's nowhere near what they want it to be. It's not, but it's helpful. It's crazy how helpful this is. The fact that I can make a video from an article that Mitch made in 1 minute and it has B-roll and subtitles, like how does it do it that fast? I don't even know. So anyways, I'm just playing with it. Other than that, guys, I appreciate you. Email me if you want to go to the rally. I would love to see you guys there. And if you guys have the opportunity, don't forget to go here. This is my Substack. I'm going to start writing my second report today. This is just another way that I can communicate with you guys, create another community outside of YouTube, because YouTube is absolutely destroying me right now. Because YouTube only wants me to talk about certain things and use TikTok videos. They do not want me to talk about things that I want to talk about, which I think are important. They want me to talk about TikTok videos and React. That's what YouTube wants me to do right now. So for the love of God, please, let's make a community. Either there, you go to my Facebook. We have a Facebook that's public, meaning you guys can upload your own videos and send in your own comments because it's a public page. It's not just me. So I want you guys to go there. But if you guys can, go to my Substack. And if you really feel like you can, subscribe. It costs $12 a month to subscribe. I'm going to write this. This is really cool. Okay. So I'm building that out. I really just am here to say that I want to help you. Okay. And hopefully we can learn and grow together. And I love you guys and I appreciate you. That's really what I'm saying. So this is from Austin. Thank you, brother. I lease apartments in New York. I can confirm the last 3 months have seen the fastest drop in rents since pandemic. So, you know what would be cool, Austin? Maybe we could do an interview if you can, or email me. But if you can get some video of some of like these buildings, especially because you lease apartments, if you can get us some videos of that, I would love to interview you. So if you give me some videos of how like these skyscrapers are empty, send that to me, email me, and then maybe come on the show and do an interview and just tell us what you see. That would be amazing if you could do that. So email me if you can. Don't forget, you guys, the rally. Monica, I love you always. It's nice to see you. I was worried I wasn't going to see you this morning. I actually thought that. Nikki, it's really nice to see you. Crystal, nice to see you. P Nice, where's Austin? Where's everyone? I appreciate you guys. I'm going to get out of here. Don't forget, everything will be uploaded to the course. Go to the Substack. Be patient. Let's all stick together. And if you can, go to the rally. And also, don't forget this. This one's for you. So I made an outro. This outro is for Logan. He's with Housing Wire. And I'm going to explain why I made this intro, because a lot of people don't understand the intro that the outro that I made. Logan is with Housing Wire. He's on X, and this guy loves to act tough and bully people that think that the housing market is going to crash or there's turmoil. And he's, over the last week, been trying to harass Melody Wright and Adam for the video they did, saying, "Oh, let's debate me right now." So I went in and threw myself right into the middle of that drama. And I was like, you want to debate someone? Why don't you debate someone with a license that knows how to take raw data and to show people how to get a great deal? I will prove to everyone that your system and macro data is trash and that it helps no one except for you. So if you want to debate, sir, I'll debate you. But instead of that, this guy is tough. I'm going to debate anyone, right? He debated George Gammon. He just blocked me, and he blocked me because I believe he knows that macro data is trash when it comes to local real estate analysis. And having said that, once again, happy Tuesday. I love you. Look out for our videos. Don't forget to share this, like it, comment, and go love some people. And if you're out there investing in real estate, you guys already know I wish you luck, and I hope you.
Claims today were at 291,000, not 191,000.
Sit down. Behave yourselves.